Real estate investment trusts, REITs, and bonds are two of the most popular financial instruments for investors seeking income, diversification, and stability. While both offer unique advantages, they cater to different financial goals, risk appetites, and market conditions. REITs allow individuals to invest in income-generating real estate without owning property directly. By pooling funds from investors, REITs purchase and manage properties such as shopping malls, apartments, office buildings, and even healthcare facilities. Investors earn income through dividends, typically higher than average stock payouts. REITs also offer exposure to the real estate market, often serving as a hedge against inflation. Bonds, on the other hand, are fixed-income securities. When you buy a bond, you're essentially lending money to an issuer, whether it's a government or corporation, in exchange for regular interest payments and repayment of the principal at maturity. Bonds are widely regarded as safer investments than stocks or REITs, making them a popular choice for risk-averse investors. This video will dive into the key differences between REITs and bonds, breaking down their characteristics, benefits, and risks. We'll also discuss which type of investment may suit your portfolio, depending on your financial objectives. Whether you're a seasoned investor or just starting out, this comparison will equip you with the insights needed to make informed decisions. So, let's get started on this journey to uncover the unique world of REITs and bonds. REITs, or real estate investment trusts, are companies that own, operate, or finance income-generating real estate. They provide a way for investors to earn a share of the income produced by commercial properties without having to own or manage the properties themselves. These trusts invest in a diverse range of real estate, including apartment complexes, shopping centers, office buildings, warehouses, and even hospitals. The primary advantage of REITs is their ability to pay high dividends, as they are required by law to distribute at least 90% of their taxable income to shareholders. Most REITs are publicly traded on stock exchanges, making them easy to buy and sell, similar to stocks. This liquidity is a major benefit for investors who want exposure to real estate, but need the flexibility to access their funds quickly. Additionally, REITs offer diversification because they often invest in a variety of properties across different sectors and geographic locations. However, REITs are not without risks. Their performance is influenced by real estate market conditions, interest rates, and broader economic trends. As a result, their value can fluctuate, making them less stable than some other investment options, like bonds. Despite these risks, REITs have gained popularity among income-seeking investors due to their potential for high returns and consistent dividend payouts. Bonds are fixed-income securities that act as loans made by investors to borrowers, which can be corporations, municipalities, or governments. When you purchase a bond, you are essentially lending money to the issuer in exchange for regular interest payments and the return of your principal when the bond matures. Bonds are widely regarded as one of the safest investment options, especially government bonds, which are backed by the full faith and credit of the issuing government. They are ideal for risk-averse investors who prioritize stability over high returns. One of the key features of bonds is their predictability. With fixed interest payments, investors know exactly how much they will earn over the bond's term. This makes them a popular choice for those looking for a steady income stream, especially retirees. However, bonds also have their limitations. Their returns are generally lower than stocks and other higher-risk investments. Additionally, bonds are sensitive to interest rate changes. When rates rise, bond prices tend to fall. This makes timing an important factor when investing in bonds. Despite these challenges, bonds remain a cornerstone of conservative investment strategies, providing a stable and predictable source of income. When it comes to returns, REITs and bonds serve very different purposes in an investment portfolio. REITs are known for offering higher potential returns because they invest in income-generating properties. These properties grow in value over time, and investors benefit from both dividends and potential capital appreciation. Historically, REITs have provided average annual returns of 8 to 12%. On the other hand, bonds offer more modest returns. Government bonds, for example, typically yield 1 to 3%, while corporate bonds may offer slightly higher rates. While these returns are lower than REITs, they come with much less risk. Bonds are designed to provide steady, predictable income, making them ideal for conservative investors. However, the trade-off between risk and reward is key. REITs carry higher risk due to market volatility, interest rate fluctuations, and the performance of the real estate sector. In contrast, bonds are less sensitive to market conditions and serve as a safe haven during economic uncertainty. Ultimately, the choice between REITs and bonds depends on an investor's financial goals and risk tolerance. Those seeking growth and higher returns might lean toward REITs, while those prioritizing stability and regular income may prefer bonds. A diversified portfolio often includes both, balancing their strengths and weaknesses. Liquidity is another important factor when comparing REITs and bonds. Publicly traded REITs are highly liquid, meaning investors can buy or sell shares on the stock market at any time during trading hours. This flexibility allows investors to respond quickly to market conditions or personal financial needs. In contrast, bonds are less liquid, especially if they're not traded on secondary markets. While government bonds can be sold easily, corporate bonds or municipal bonds may not always have ready buyers. Selling a bond before its maturity date can also result in a loss, especially if interest rates have risen since the bond was purchased. This difference in liquidity often makes REITs a preferred choice for investors who want easy access to their funds. However, the frequent buying and selling of REIT shares can expose investors to market volatility, potentially leading to losses if sold at the wrong time. Bonds, though less liquid, offer a predictable schedule of interest payments and a guaranteed return of principal if held to maturity. This makes them a reliable option for investors who prioritize security over quick access to their money. Risk is an unavoidable aspect of investing, and understanding the risks associated with REITs and bonds is crucial for informed decision-making. REITs are subject to market volatility, making them more susceptible to economic downturns, interest rate hikes, and fluctuations in the real estate sector. For example, during a recession, property values and rental income may decline, directly impacting REIT returns. Bonds, in contrast, are considered a safer investment. Government bonds, for instance, are backed by the full faith and credit of the issuing government, making them virtually risk-free in terms of default. However, they're not entirely without risk. Bonds face interest rate risk, meaning that rising interest rates can reduce their market value. Inflation is another risk, as it can erode the purchasing power of bond returns over time. One unique risk to REITs is their reliance on debt. Since REITs often borrow to acquire properties, they are sensitive to changes in interest rates. Higher borrowing costs can reduce profitability and dividend payouts. Meanwhile, bonds with longer maturities carry greater exposure to interest rate and inflation risks, which can impact their overall value. Investors must weigh these risks against their own financial goals and tolerance for uncertainty. While REITs offer higher potential returns, their volatility may not suit conservative investors. Bonds, though safer, may not provide the growth needed to meet long-term objectives. A balanced portfolio can help mitigate these risks. Both REITs and bonds offer income potential, but the way they generate passive income differs significantly. REITs are required by law to distribute at least 90% of their taxable income to shareholders as dividends. This makes REITs an attractive option for investors seeking high dividend yields. The income from REITs is typically higher than the interest earned on bonds, providing a steady cash flow for income-focused investors. Bonds generate income through interest payments, also known as coupon payments. These payments are fixed and made at regular intervals, offering a predictable and reliable income stream. The income from bonds, however, is generally lower than REIT dividends, especially in low-interest rate environments. REIT dividends can fluctuate based on the performance of the underlying properties and rental income. For instance, during economic booms, REITs may offer higher payouts due to increased property demand. Conversely, bond interest payments remain unaffected by market conditions, providing stability in times of economic uncertainty. Investors looking to maximize income often consider a mix of REITs and bonds. This combination allows them to benefit from the high dividend yields of REITs while maintaining the predictability and security of bond interest payments. Understanding these differences helps investors tailor their portfolios to their income needs and financial goals. Liquidity is a critical factor when evaluating investment options like REITs and bonds. REITs are traded on major stock exchanges, making them highly liquid. Investors can buy or sell shares of REITs during regular trading hours, allowing for quick access to cash when needed. This liquidity is especially valuable for investors who may need to access their funds in the short term. Bonds, on the other hand, are less liquid compared to REITs. While government and corporate bonds can be traded in secondary markets, the process is often more cumbersome and less transparent. Additionally, the bond market typically has lower trading volumes, which can result in wider bid-ask spreads and higher transaction costs. Another aspect of market access is affordability. REITs are more accessible to everyday investors, with low entry points and the ability to purchase fractional shares through certain platforms. Bonds, however, often require larger initial investments, especially for individual bonds, making them less attainable for smaller investors. Investors who prioritize liquidity and ease of access often lean toward REITs. However, those seeking long-term stability and are less concerned about immediate liquidity may find bonds more suitable. The choice between REITs and bonds ultimately depends on the investor's financial goals and liquidity needs. Taxation plays a vital role in shaping investment decisions, and both REITs and bonds have unique tax implications. For REITs, one of the key advantages is their tax-efficient structure. REITs are required by law to distribute at least 90% of their taxable income as dividends, which allows them to avoid corporate income tax. However, for investors, these dividends are often taxed at ordinary income rates, which may be higher than capital gains tax rates. Bonds, on the other hand, are generally considered more tax efficient for certain investors. Interest earned on government bonds, such as municipal bonds, is often exempt from federal income tax and, in some cases, state and local taxes. However, corporate bond interest is fully taxable, making it less attractive for high-income investors. Additionally, the capital gains from selling bonds before maturity are subject to taxes, though the overall tax burden is often lower compared to REITs. Tax efficiency often depends on an investor's tax bracket and the type of account holding the investment. For instance, REITs can be an excellent option within tax-advantaged retirement accounts, where dividend taxation is deferred. Bonds, especially tax-free municipal bonds, can provide ongoing tax savings in taxable accounts. Understanding the tax implications of REITs and bonds can help investors optimize their after-tax returns. Consulting a tax advisor or financial planner is highly recommended to create a strategy that aligns with personal financial goals and tax situations. Investing is an art as much as it is a science, and making informed decisions about where to place your money is critical to achieving your financial goals. Today, we explore the dynamic worlds of REITs and bonds, two investment options with distinct advantages and unique characteristics. Whether you're drawn to the high-yield potential and market exposure of REITs or the stability and predictability of bonds, the key takeaway is that there's no one-size-fits-all approach. Remember, your investment strategy should always align with your financial goals, risk tolerance, and time horizon. Diversification is often the smartest choice, as combining different asset classes like REITs and bonds can help balance risk while maximizing potential returns. If you found value in this video, please give it a thumbs up, subscribe to our channel, and hit the notification bell so you don't miss any of our future financial insights. We're committed to bringing you actionable advice to help you grow and protect your wealth. Thank you for joining us on this journey. Feel free to share your thoughts and experiences in the comments section below. What's your preferred investment option? REITs or bonds, and why? We'd love to hear your perspective. Until next time, happy investing, and remember, every financial step you take brings you closer to your goals. Goodbye, take care, and see you in our next video.